This is Nightly Business Report with Bill Griffith and Sue Herrera.
Sales streak. Walmart is taking market share from competitors as it pushes further into the one thing that everybody needs: food.
Layoff stocks. Fidelity says baby boomers are too exposed to equities. But where else do they go to find returns?
Ranking reliability. Everyone wants to know how their car or truck will hold up after they buy it, and a new report has the answer. Those stories and more tonight on Nightly Business Report for Thursday, November 14th.
And we do bid you a good evening, everybody, and welcome. The S&P 500 was the lone index to close at a record today, and it did it despite declines in the shares of two influential stocks, Cisco and Walmart. In fact, Walmart is where we begin tonight. Shares of the world's largest retailer started the day at a new high after the company reported better than expected earnings and said that the future looks bright. But that's not where the stock ended the day. Shares drifted lower after the open this morning, and they were down fractionally by the close. But the low-cost retailer's sales are on a 5-year win streak, a good sign when it comes to the health of the consumer, the economy, and the drivers of Walmart's business. Here's Courtney Reagan.
Walmart continues to grow sales in the U.S. thanks largely to its grocery business. U.S. comparable sales grew for the 21st straight quarter with both strong traffic in stores and growth online. Digital sales increased more than 40%. While Chief Financial Officer Brett Biggs told me many categories were strong, the retailer's food business and its expanding delivery and pickup options is what's driving shoppers to spend.
Grocery delivery, the grocery pickup, they're all building customer loyalty that continues to drive the positive growth that we're seeing at Walmart.
E-commerce was only about 5% of Walmart US's total revenues last year, but here it's growing, upwards of 40%. And if you look Walmart versus Amazon e-commerce, that's triple the growth rate of Amazon. And so that's what's really driving the overall same-store sales growth. And it's really being driven by the grocery pickup and less so grocery delivery.
While analysts are largely positive about Walmart's grocery programs, there is some concern about where growth will come from next.
A lot of the growth right now is coming from the rollout of online grocery pickup. That's accounting for a quarter to a third of the growth in the U.S. business. As they fully penetrate that, the rollout of that, it may be a little harder to sustain the 3% plus comp growth.
Grocery is more than half of Walmart's total sales. It's been the most important category for some time. While new online grocery options are driving business to Walmart, grocery has low margins, making it a less profitable business than a category like clothing. And the retailer's online business is still expected to lose more money this year than last year. In their prepared remarks, CEO Doug McMillon addressed the issue, saying, quote, "Our strength is being driven by food, which is good, but we need even more progress on Walmart.com with general merchandise." And, quote, "We need to translate this repetitive food and consumable volume into a stronger Walmart.com business that's profitable over time. So that's what we're working on." In the meantime, the bigger near-term test is the holiday season, with Black Friday just over 2 weeks away. For Nightly Business Report, I'm Courtney Reagan.
Let's turn to Charlie O'Shea to talk more about Walmart's better-than-expected earnings. He is the retail analyst for Moody's. Welcome back, Charlie. Good to see you.
Hey, Sue, good to see you.
You say that the business model that Walmart has put in place speaks to its execution and sensibility of strategic investments. I would assume that means that they are well positioned for the holidays.
Oh, yeah. I don't think there's any question Walmart will set the tone this holiday, along with, the usual suspects that we talk about a lot when I see you guys: Amazon, Best Buy, Target, Costco's in the mix, the off-price stores as well. But Walmart is in as good a shape as I've seen it in the 17 years I've been covering it at Moody's.
Good e-commerce numbers, yes, but I sense from those comments from Doug McMillon that he's a little, I don't know, he's not upset, but he's impatient with the growth rate he's seeing with the e-commerce division overall. What do you think?
I think Doug McMillon is always impatient, and Doug McMillon always thinks this company can do better. And that's one of the things that has made the company as successful as it's been over the last 4 or 5 years since he took over. He put a strategy in place 4 years ago. It got beat up pretty well by the equity, but it's paying off, and Doug and Brett and the rest of the team at Walmart are very focused on success, and they want to win everywhere. And they're well positioned to win in most places right now.
Speaking of everywhere, what about their international business, Charlie? Domestic seems to be executing well, with the exception of they want to improve the online experience. But they bought Flipkart, and they have expanded pretty aggressively internationally. How are they doing?
Well, the international business has always been a focus, and it's always been kind of transitory. They tried to get out of ASDA. That didn't work. The British government shot that down. But they've made a very strong and large and successful push into China, with the joint venture with JD. Flipkart is going to take time. I think the company realized it. We certainly recognized it. We didn't feel Flipkart would show profits until at best very late in 2020. So they're not upsetting us at all from that perspective. But the demographics in India are compelling. And if you want to be a true global retailer, I think you need to be there. Brazil, they punched out of Brazil. Brazil was challenged. But really what Walmart's done historically, at least since I've covered it, is they've recognized when to cut losses, when to get out, and when there's better opportunities somewhere else. They've done that in Germany. They did it in South Korea. Now they've done it in Brazil. They're going to try to do it in the UK. And the place to deploy your assets is India and China right now.
On that note, Charlie O'Shea with Moody's. Thanks, Charlie.
Thanks, Sue.
Now, while Walmart says that the consumer remains strong, business investment is still showing signs of weakness. In fact, Cisco says it is seeing a slowdown in corporate technology spending, and it issued disappointing guidance, which we told you about last night. And it's something the CEO reiterated again today.
Those of us who rely on business investment and capital investments have been expressing concerns over things that we're seeing in the marketplace. And we actually mentioned it on our last call. So this is not something that has just newly emerged. And what we talked about at the end of last quarter of Q4, when we said we began to see some weakness, just manifested itself throughout the quarter. So you heard Chairman Powell yesterday talking about his concern over business investment, and I think that's the issue that we're facing. The consumer in the U.S., as you see from Walmart and others, has remained very strong, and it's a bit of a dichotomy in the market right now.
Cisco's stock was down 7% today, making it the worst performer in the Dow today.
In Washington, Federal Reserve Chair Jerome Powell was back on Capitol Hill for his second day of testimony on the economy. He said that even with stocks at or near new highs, there are no signs of bubbles brewing.
Look at today's economy. There's nothing that's really booming that would want to bust. In other words, it's a pretty sustainable picture. I pointed out the risks, and those are in manufacturing. Manufacturing is declining, but not sharply. Manufacturing is more sensitive economically to cycles, so it does decline.
Meantime, the president of the New York Fed said today that interest rates are at an appropriate level given the pace of economic growth. According to economists, that is an indication that he thinks no further rate cuts are likely if current conditions remain.
Speaking of the economy, producer prices saw their biggest gain in 6 months in October. That report from the Labor Department showed an increase of 0.4%, lifted by gains in healthcare costs and specifically outpatient care at hospitals, which posted its largest rise in a decade. A separate report showed that the number of Americans filing applications for unemployment benefits rose by 14,000 to 225,000 last week. That was the highest reading in 5 months.
As we've mentioned, the S&P 500 eked out a record close. There was little excitement, though, given the pullback in Walmart and Cisco's shares. And the major averages closed just about where they did yesterday. The Dow Jones Industrial Average was down 1 point to 27,781. The Nasdaq slid 3, and the S&P 500 rose more than 2.
Small caps, though, today also pulled back slightly. The group has been underperforming the rest of the market for the past 2 years. But some say the gains could start to pick up. We're joined tonight by Laureen Gilbert, president of Wealthwise Financial Services. Laureen, good to see you. Thanks for joining us tonight.
Thank you so much.
There's been a lot of hope surrounding the small caps for a few years now. Why are they still lagging this market, do you think?
You know, I think that this entire year has been marked by trade and the uncertainty around a trade deal. We've said that since the beginning of the year, and we've seen that in the markets. Every time we think there's a trade deal, the markets go up, and when there's trade uncertainty, the markets go down again. And that would be characteristic of your small caps. When people feel uncertainty and when they want to become more defensive, They go upward in capitalization. They go up towards your larger cap companies that they feel more comfortable with.
If you were to invest in small cap stocks at this point, where would you go?
If we look at what's less expensive than other parts of the market, I would look at your small cap value relative to, let's say, small cap growth. So I'd say your small cap growth is more expensive and your small cap value is less expensive. And so that kind of value would lean towards making investments in that area.
But what you're saying here is that as long as this market is pretty defensive, and for the most part we are seeing the defensive issues outperform this market, small caps will also underperform. When we get that trade deal, does that change, do you think?
It does. I think we could see a pop, and that's what people are waiting to see, waiting for in hopes of a trade deal, that we would see a pop in the small cap arena that would encourage investment.
Where would you go specifically? What areas, if you decided to go into small cap value, what areas do you like?
So technology overall has been the winner year to date as far as the sector is concerned. And certainly there are areas of technology that could be invested in. That tends to be more of a growth story than a value story. But another area would be the way that technology is impacting other sectors of the market, for instance, healthcare innovation. And there are opportunities there, and that would be more of a value story. The other area that I would encourage people to look at as a possible investment in small capitalization would be international small cap. That's not just the U.S., because our U.S. investors tend to invest more in the United States, and they tend to forget about other areas of the market. And small cap international companies are an opportunity.
Laureen Gilbert with WealthWise Financial Services. Again, thanks for joining us tonight.
Thank you very much.
It is time to take a look at some of today's upgrades and downgrades. Apple was downgraded to sell from hold at Maxim. The analyst cites the potential for lower than expected iPhone sales next year. The price target is $190. The stock fell a fraction to $262.64. Kraft Heinz was downgraded to sell from neutral at Goldman Sachs. The analyst says he believes profit at the company will continue to shrink. The price target is $29. The stock fell about 6% to $30.96.
Verizon was downgraded to hold from buy at HSBC, with the analyst citing increased competition and the changing business model for content these days. Price target now $65. That stock was down slightly to $59.34. And Uber was upgraded to buy from hold at Argus Research. The analyst cited an improving competitive landscape for that company's core businesses. Price target now $35, but that stock did fall more than 2.5% today to $25.99.
Still ahead, how IBM is using big data to make even bigger improvements to weather forecasting.
There are reports tonight that the state's massive Google antitrust probe is going to expand into search and into the company's Android businesses. So far, the investigation is only focused on its advertising business. The attorneys general representing 48 states, Washington, D.C., and Puerto Rico are all part of this investigation.
In Washington, the Speaker of the House said a breakthrough in the new NAFTA trade deal, otherwise known as the USMCA, could come soon. Nancy Pelosi suggested that Democrats and the White House are making progress on a final agreement.
We are moving positively in terms of the U.S.-Mexico-Canada agreement. I do believe that if we can get this to the place it needs to be, which is imminent, that this can be a template for future trade agreements.
The White House hopes to ratify the trade agreement by the end of the year.
Charles Schwab saw a 30% increase in the number of its new accounts added in September. That happens to be the same month that the brokers stopped charging commissions for trading stocks, ETFs, and options, and rivals have been taking the same step in dropping their commissions. Schwab is hoping that the free trades will attract more clients, thereby offsetting the decline in revenue.
The number of Fidelity 401k and IRA millionaires hit a record in the third quarter. 1/3 of savers increased their contribution rate during the last year, making the average 8.8%, not including the employer match. That's the highest percentage ever. In its third quarter retirement report, Fidelity also said that baby boomers have too much exposure to stocks and run the risk of big losses in a market meltdown. Bob Pisani has more.
Are baby boomers overinvested in the stock market? A new report from Fidelity found that many 401k account holders had stock allocations higher than those recommended for their age group. 23% have a higher percentage of equities than recommended. Among baby boomers, 37%. What does that mean? Well, it means that a small subset of investors might want to pay more attention and rebalance their portfolios a little bit. But it may also mean that Fidelity and other fund companies need to re-examine the way these funds allocate between stocks and bonds. For example, Fidelity recommends a maximum allocation of 70% to stocks for those 10 years from retirement. Wait a minute, though. If you retire at 65 and you live another 20 years, having a higher allocation to stocks may make perfect sense. Longer lifespans means investors can hold riskier assets longer. It's that simple. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So what is the right mix of stocks and bonds for those of us of a certain age? There's been a lot of talk about this recently. Bank of America Merrill Lynch put out a note to clients that the old 60-40 portfolio allocation is dead. Burns McKitty joins us now to talk about that. He is with Allianz Global Investors. So, where are we going to go for growth and especially for income of a certain age, as long as we're living longer these days and interest rates are as low as they are right now? What do we do here, Burns?
Well, being cognizant of the fact that there's no one-size-fits-all rule for all retirees and for all baby boomers, I think that when you do see that are more and more holding a greater proportion of equities than would be suggested by this Fidelity model, it's really just a symptom of this world of ultra low interest rates. You have a supply-demand issue whereby the supply of yielding alternatives is very low. You have low bond yields, the lowest they've been really in history, right, and the demand for yield is very high. You have, again, the baby boom generations really at the not so much the capital gains, but at the harvesting and the cash income stage of their investment cycles. And so you have an entire generation of investors who are just searching for yield anywhere they can get it. And so, some of the old metrics maybe need to be updated, but at the same time, I think that these are just people that are looking for income wherever they can find it.
And you say that makes diversification key.
Absolutely. I think that diversification is always crucial. And with people living longer, as was previously noted, I think that there is a case to be made for perhaps having a little bit higher allocation to equities. But within that, if you're looking at retirees and people within the ages of 55 to 75, they should probably look at equities that are more than anything paying attractive dividends, companies that are a little bit higher quality, and in many cases to reduce risk and reduce volatility, looking at larger cap names that might be a little bit more domestically focused.
Where do I go when I'm not in equities and I want income of some kind? I mean, the old master limited partnerships and some of those things that were so popular a generation ago. Do I look at those still these days?
Yeah, I think that there's a case to be made for those. I think that there should at least be some allocation to. I think one that'd probably be a little bit contrarian would be to inflation-adjusted treasuries. Right now you have inflation expectations are the lowest they've almost ever been, and so you can't imagine them going too much lower from here, which would make a case for these securities. But really, I think that I think investors should have a dynamic diversification of their portfolio whereby they reduce that equity exposure as they age, set targets which suggest that if you have a year like this when stocks are up 20+%, then when you reallocate at the end of the year, maybe take a little bit of your winnings off the table. That's something that really forces investors to, by definition, buy low and sell high.
Indeed. The old that doesn't die, that adage right there. Burns McKinney with Allianz Global Investors. Thanks again for joining us.
Thank you for having me.
Ad growth helps sales at Viacom. That's where we begin tonight's market focus. The media company, which includes VH1 and MTV, beat expectations thanks to an increase in its domestic television ads. Viacom's Paramount division posted a full-year profit for the first time in 4 years. Viacom shares rose nearly 2% to $22.47. Canopy Growth reported a wider than expected loss for its latest quarter, hit by restructuring charges, but revenue at the Canadian cannabis producer did come in higher than analysts had been expecting. The company also says it will not make any large investments in Canada due to only moderate demand for cannabis products there. Canopy shares were down more than 14% to $15.84.
After the bell, an SEC filing for the third quarter revealed that Berkshire Hathaway has taken a position of more than 1 million shares in home furnishing retailer RH, used to be called Restoration Hardware. RH shares initially rose in the after-hours trading on that news. They closed the regular session today up more than 1% to $175.22. And Nike is hiking its dividend by 11% to 24.5 cents a share. The yield will be a little over 1%. I don't know if boomers want to look at that for income. Nike shares were initially higher in after hours, offsetting the fractional loss during the regular session where they closed at 91.27.
Well, if you're like most of us, you complain about the weather and the incorrect forecast. IBM is trying to fix that. It is combining the power of supercomputing with big data to provide far more accurate forecasts, which businesses can use to make their operations more efficient. Steve Leisman got a first-hand look.
In developed countries like the United States, our smartphones warn us of looming storms, bitter cold, or searing heat. But billions of people around the globe lack even basic weather forecasts, making the world a much more chaotic and dangerous place. But in an historic marriage of big data and supercomputing, IBM is launching Graph today, the global high-resolution atmospheric forecasting model. IBM says Graph will provide accurate weather forecasts not for a few places around the world, but for the entire world.
What you're hearing is the sound of Deus, the IBM supercomputer that runs this new global weather model. It's named after an ancient god who ruled the daytime sky. It consists of 9 cabinets that has 84 nodes in it. It outputs 12 trillion pieces of weather data every day for 26 million locations around the world.
The supercomputer is so fast, this massive model provides new forecasts every hour instead of every 6 hours.
We're actually getting down to kind of the cellular level of the thunderstorms now, where we weren't able to do that before. And with that information, we can now provide better support to critical decision makers.
It's big potential business because big companies increasingly need accurate weather data.
Any business that doesn't have a weather strategy is missing out on returns. All is tied to your environment and the weather. Being able to predict that in advance for retailers, energy companies, travel and transportation businesses is all we do.
Better international weather forecasts can mean more comfortable flights for passengers who are routed around turbulence, and even shorter flights.
If we can do a more fuel-efficient flight, we can certainly save money on fuel. There's just a variety of ways that operating on time and efficient manner improves the American bottom line.
No matter how good the tech, a new weather model has to prove itself over time. American will wait at least several months before relying on it, and then only along with all of its other weather data. IBM has plans to continuously upgrade the model, adding real-time weather data from airplanes in the sky and even from smartphones. For Nightly Business Report, I'm Steve Leisman.
And coming up, the new list of the most reliable vehicles on the road. Do you drive one?
The Postal Service lost nearly $9 billion for the full year. And while that may seem steep, a closer look shows not everything is bad. Free cash flow was positive, and postal sales grew slightly, even as first-class mail volume shrank. Next year, the Postal Service plans to raise prices in its parcel shipping business by about 3%.
Finally tonight, 1 year after dropping Tesla from its list of recommended vehicles, Consumer Reports has changed its mind. The good news comes from the latest Consumer Reports annual auto reliability survey, which also has some troubling news for Cadillac. Here's Phil LeBeau.
It is the question everybody asks themselves in the showroom. Will this car or truck hold up after I own it? Consumer Reports, which tests hundreds of models, once again asked its members to review their vehicles. The result? Our cars are better, but the technology still has glitches.
The biggest thing is that you're no longer seeing engines fall out of the car, major problems with the powertrain, the drivetrain. But what you do see is that a number of electrical issues, such as the infotainment system, but also the computers that work for all the different systems, tend to be more problematic.
Consumer Reports rates Lexus as the most reliable brand, followed by Mazda and Toyota. But some other results also stand out. For example, every Korean model has average or better reliability. Meanwhile, Consumer Reports is returning Tesla to its recommended list, thanks to improving reliability with the Model 3 and the Model S.
What we've seen is that, much like the industry, as a Tesla builds more vehicles and they have another model year after that, they go and they fix the problems.
This year, Cadillac was rated dead last, right behind Alfa Romeo and Acura. Does it hurt sales if a brand is rated near the bottom of the reliability list? Maybe not. Jeep has historically struggled with its reliability ratings in this country, and yet it is one of the hottest brands when it comes to sales. Phil LeBeau, Nightly Business Report, Chicago.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.